going on in the hotel industry. Just look at this one block in Chicago. These might seem like 3 different hotels, but they're actually all Marriott. Over the past 20 years, Marriott has more than tripled in size. And we can trace this boom back to a decision Marriott made decades ago to move away from the real estate business and instead commodify its name.
Well, of course, as you might imagine, we think we're the best. We are the largest, 8,700 hotels in 139 countries and territories, really showing expertise around the world for what we think hospitality means.
And you can see the same happening for competitors like Hilton and now Hyatt, because they're also following a similar playbook.
It's commonplace to actually invest behind real estate in order to build a brand and over time sell down real estate. We wanted to do it in a very deliberate way.
With this business model, the brands don't have to run most of the hotels that fly their flags, nor do they have to pay for them. In most cases, that responsibility falls on people like this guy.
So independent owner-operators like us generally own it. Most people think that they are Marriott employees, they're generally MCR employees.
So why did this shift happen? And how does it affect the customers? This is the economics of hotel chains. The business today looks like this. These are the names you're familiar with: Marriott, Hilton, Hyatt. And these are the players who actually front the money to buy the real estate, hire the employees, and run the day-to-day operations. Owners pay to use these big hotel names, referred to as flags in the industry. And it's a departure from the tried and true strategy of decades before.
If you go back to the 50s, everything was owned, operated, and flagged by the same person.
MCR is the 3rd largest hotel owner-operator, behind these 2 real estate investment trusts.
We get all the revenue, and then we get whatever profits are left over. And we pay Marriott or Hilton a franchise fee to be part of their system.
That means hotel brands mainly have money to gain with every new hotel.
Because they were not on the hook for the asset cost, they were able to scale up their brands much faster.
Moving to franchising removed a lot of the financial risks associated with real estate.
One of the things we realized as those hotels got more and more popular is that by building them all on balance sheet and with dealing with economic cycles, we were constrained. Our growth was constrained.
Now, Marriott and Hilton each own less than 1% of their properties, while Hyatt owns about 2%. But in shifting to this strategy, major hotel brands now have to focus on a new customer.
The owner is the one that puts the brand onto the hotel, and that's what drives franchise fees to the brand.
Those fees can amount to anywhere from 5 to 15% of what the property brings in. So the brands have to prove that having the name is worth it. Hotel brands say,
It more than pays for itself.
because in addition to data on how lobbies should look and what amenities to have, they also provide data to help the owner get the most money for each room each night.
At the end of the day, you are saying, what will the market bear? When there's a Taylor Swift concert coming into a market, we see the rates literally out to 40 miles away go crazy.
In dynamic cities, the price of a room could change multiple times in one day.
We get questions all the time, and they say, I was going to book for $199, and now the rate just went up to $249. Then you should have booked at the $199. The prices are fleeting.
Every one of our full-service hotels has a revenue manager, and they take account of what's going on in that particular marketplace.
And these systems also calculate rates that optimize for the hotel's bottom line.
We don't want to sell out our hotels just on Tuesday, because that leaves us exposed on Wednesday. So we may sell you that room at an extraordinarily high price, because what we really want is for you to book Monday to Wednesday or Tuesday to Thursday.
This helps make up for less profitable days.
We're giving the rooms away on Sunday. It is the worst night of the week because business travel does not really occur on Sundays, and neither does the hotels.
Flying a flag can also help owners target wider pools of hotel customers, with better fees for booking platforms like Expedia and Booking.com.
So if you buy a hotel room via Expedia for a Marriott hotel, we pay a lower Expedia fee, we the owner.
But analysts say an even bigger draw are hotel loyalty programs. Marriott and Hilton each have over 180 million members. Hyatt has more than 40 million. And thanks to points, guests are incentivized to shop within these programs.
The points have essentially become currency.
which can help increase the customer base for flagged hotels in smaller markets.
If you're in a secondary or tertiary market, you generally fly a flag because that brings people to your building because they want the points. The idea is you earn the points in Arizona, and then you redeem them in Miami.
Today, 2/3 of all hotels in the US are branded, but the franchise model